The era of cheap money is dead, meaning economic growth could be hard to come by next year. Let's talk more about what this will mean to the markets with Neil Shah, Edison Group Director of Research. Good to see you here, Neil. Look, we were just talking about in the pre-market here. We might be seeing a Santa Claus rally. Does that mean investors should back up the truck into your end?
Yeah, I mean, look, I mean, I think that since the mid-year, equities remain, valuations are starting to look a little bit more attractive, and I think there is a willingness to start participating in equity markets. The question is where. So you highlighted that consumer discretionary had been underperforming, and that I think is just a reflection of what we're seeing, which is that central banks are tightening. That pain is being taken on by the consumer. There's lots of discussions about this time round the consumer in a stronger position than perhaps the financial crisis. I think the major difference this time round versus last time round is that we're going to see very different central bank policy going forward. So that bailout that happened last time round, the asset price inflation that happened last time round, I don't think we're going to see that, and that means it's going to be, the brunt of this is going to be borne by the consumer. Instead, we're seeing a rotation into old school economy names. So I think you can see that reflected in the Dow and the NASDAQ. Dow's 6% of its all-time highs. The NASDAQ is down much further, something like 30%. And you're seeing this rotation out from growth into those companies that have real assets, are generating cash flows. The barriers to entry to putting in those real assets are what is attracting people, and that. So I think there is going to be participation in the markets, just in different areas.
Well, and Neil, let me ask you, drill down into some of the sectors or styles that you're looking into the market. You noted that big outperformance by the Dow relative to the NASDAQ. Do you expect that to continue? And then drilling down into drilling down a little bit into the indices, where do you see that outperformance to exist?
Well, when I talk to professional investors, there is this pivot that's taking place from growth into value. And how are they expressing that? So the expectation is that while you might see some moderation of inflation, it's going to be persistent. There's going to be some second order effects next year as the cost of living increases start to come through in pay packets. And so there is a feeling that inflation and rates are going to be sticky for a period of time. In most managers' minds, we're going through a long period of muted growth, and there's three things really driving that. There is the rate environment. There's the fact that China is going ex-growth, and you're seeing a certain amount of deglobalization happening at the same time. So where are they then thinking about sort of participating? They're participating in some old school economy names because you can invest in a company where you may not necessarily see capital gains growth over the course of the year, but because you're compounding those dividends and they're cash flowing, they're paying out those dividends, you are getting returns. The other place where actually there is an interest is in the smaller companies. So, this idea that it's much easier for a $100 million company to double its revenues than it is for a $2 billion revenue company to double its revenues. And so those companies that are nimble, that are going to likely to increase market share, is also an area of interest. The funding environment is going to remain difficult. And I think that the reason that there's an attraction to the companies that have listed is that they're probably in a position of strength compared to their private peers. So there's going to be some expectation that you see some consolidation in the market, that you see an improving sort of market position as a result of that, better pricing power coming through. And that's how investors are sort of positioning for alpha. The other thing I'm sort of picking up is that in these old economy names, a lot of the alpha is also coming through investments by these companies to make themselves more carbon neutral, better, a better position from an ESG perspective. So that is also on investors' radar. So when you're drilling into the sectors, I think it's, the capital goods companies, those B2B companies. But at the same time, occasionally people are revisiting, growth names, tech names, because you will find, given the sell-off, something that's sold off to such an extent that it starts to look like a values play.
Neil, I'm being tasked with writing a predictions piece on the markets for next year. I'm really coming up empty. I don't have anything good. Hit us with one big prediction for the markets next year. You have 30 seconds.
I think markets will be up compared to this year, next year, and old economy names are going to outperform new economy names.
Way to bring it. That's what I'm talking about. Edison Group Director of Research, Neil Shah, thanks for coming on. I know it's a busy holiday week. We'll talk to you soon.
Thank you very much.